All right, good morning, everybody. If you haven't done so yet, do me a favor and go over to my YouTube page. Please like and subscribe to these videos. It's going to be a goal of mine for next year to get that YouTube page up. Now, really, at the moment, I use it for recording these so that if somebody wants to come back later and watch the replay of the morning briefing, then they can do that. But it also has options, tips, and other things. Thinkorswim videos, setting up your Thinkorswim, all sorts of material that I have put out over the years. Next year is really going to be a drive for new traders. Still think there's this really big gap that new traders are falling into. When it comes to advanced material, that's always been my forte. It's what everybody always wants. But there's a lot of new traders and they're new coming in every day. So we're going to see a lot more of that in the new year. And yeah, so help me out. Keep the channel analytics moving in the right direction. If you don't understand some of the concepts that we go through in the morning briefing, I put this morning briefing together years ago as a demonstration tool, kind of a proof of concept. I was working at a place where I was teaching these concepts, making videos on different things, but when it comes to the morning briefing or when it comes to getting prepared for the day, I couldn't wrap that up into a 30-minute video. There's just so many things that need to be covered. So I started doing it live with the idea that if somebody could see it done consistently over and over and over again, and you had some of the backdrop, the parts and pieces of what we're doing and why we do it every day, then you would get to the point where you could do it yourself. That's my goal with doing these morning briefings. Sure, I'm giving you a fish today. I'm going to give you my take, my insight, what I think the market's going to do, where we're going. But my real goal is to get you to the point where you don't need me. You can do it yourself because maybe you want to day trade stocks or you want to day trade options. Maybe you want to trade something that I'm not looking at. And if you learn how to do the briefing your way, then you can look at things that will benefit the way that you want to trade. So yeah, I'm giving you a fish, but the goal is to teach you how to fish. So if you want some parts and pieces, some of the background on the morning briefing, just go to the website and start working through the blog posts. I've laid it out really well. There's multiple posts that explain the different things that we're looking at and give some tips and tricks and clues. Lots of website links for free materials so that you can know where to go to get the resources that you need without paying a lot of money for them. Because, we all, I think, have a lot of subscriptions to things. And why get more subscriptions if you don't need them, right? Free is good. I like free. We're going to get some GDP data today. And this seems to be the last shoe to drop for the year when it comes to what the markets are looking for that may affect the Fed's rate decisions into the new year. So let's keep our eye on the headlines today and see if the markets respond to anything. The put wall was rolled up again, and we're now in this sort of gamma pinch or gamma squeeze. The gamma pocket, so to speak, has shrunk considerably. If if you look at the picture that I had sent into the chat, if that wasn't a put wall call wall and instead was something like, say, Bollinger Bands or Keltner channels or something like that, that had this same sort of pinching maneuver, we would consider that a squeeze, right? So, don't get lost in the fancy phrases or anything like that. We're just looking at how the put wall has rolled up really tight against that call wall. And we can see what's happened in the past when we rolled into this, that the put wall gets moved back out. Either because price moved down and pushed the put wall down, or they just broadened it back out, rolling it out even if price didn't follow. So you have the dates of when it happened before, and you could go back to, say, November 30th and look at what happened back there to November 6th, or back here 10/27 into 11/1, and even back here 10/9 into 10/15, and see what happened on those dates after the put wall got rolled up into this sort of pinching maneuver. Is it perfect? No, we've only got 3 data sets here to go back and look at, but it gets you started. And if you have Spot Gamma platform, then you can just, use the platform, go back even further. And I could have left price turned on because, I got the ability to have price on and the gamma and all the other levels, so that you have a better idea of what happens when we do this sort of pinching maneuver. But that's where we're at this morning with that put wall rolled up. This can be a springboard of structure that would allow us to push higher, but we need that call wall to move. And that's the issue, right? And the fact that they rolled the put wall up, but they didn't roll the call wall up, says they brought the puts up for us to stand against, but lean on, but they didn't move the ceiling. So we're going to keep our eye on that, see if they get that call wall moved. And I'm really not expecting it to happen this week, but want to keep our eye on it just in case. So we're mostly red around the world. Japan's slightly green. Everybody else is holding the line. We're not crazy bearish. We're just not bullish. And that's fine. That's kind of what I was looking for yesterday morning, really. I think it would have been a better start to the week if we had just opened up slightly weak, and that's because markets that just go straight up are unsustainable. And if we're going to have a little bit of a pullback, well, that's just a really good way to start the week on a Monday. We didn't get it, so what? We don't get what we want. Like that old song, right? Can't always get what you want. The GDP is a delayed report. We can see it right there. We'll take what we can get. My concern this morning is the size differential. Now, that forecast or prediction estimation, it is what it is. We're coming in a little bit from 3.8 to 3.2, but it matches on multiple websites. So they all seem to be in agreement. One concern that we have is if it misses by a wide margin, comes in at like 3.0 or even less than that, right? 2.9, 2.8. I think that's really going to shock the market. We're going to get some surprise. But then there's the other side too. The market wants those rate cuts. So bad news is good news. If we get good news like 3.6, if we match it at 3.8, if we come in at 4.2, that'd be really good news. I don't know the market's going to like that. It's going to take that rate cut off the table that they really want, right? And that they've already started to price in. So we could possibly see the unwind of a rate cut that's been priced in, and that would send us to the downside. So this is worth watching this morning to really keep your eye on. What's the numbers going to do when we come in? It's 8:30, so keep your eye on the clock, and we'll just run it from there. I'm not in the prediction business of trying to figure out if it's going to come in heavy or light, or we're going to miss drastically or not. I'd rather just look at the clock, wait for the data, and trade what we get after it comes in. I've found that to be the best case, whether I'm doing earnings or economic events. I don't try to guess. Just let the numbers come out and trade what the outcome is. We do have auctions today. The 52-week, not really one of my favorites, but, don't want to ignore data. Certainly learned that over the years. Who knew? Huh? Who knew airlines would be such a beautiful run? Over $5 just straight up like that. Boy. Now, once it did that breakout, and Busby, for those who know what I'm talking about, that's a very beautiful Busby. You had a good signal, but we didn't have a good reversal off the lows down here. Not like a really beautiful 3-bar or swing low, nothing like that. This basing and then run back up, though, that little area right there, that's the little scoop pattern that we've been dealing with the S&P and the NASDAQ, right? That's what we were just dealing with. And you can see what can happen after that scoop pattern if we make it back to the top and continue to push. Of course, there's plenty of examples of what happens when we don't make it back to the top and continue to push. All right, this is Mentor Q with their CTA models. You can use the graphs if you're a numbers person. I like the charts, kind of a picture person. So this is the S&P and the CTA positioning. Their allocation is right up against structure. We want to see if they're willing to open their wallet, grab a bit more, or if they're going to continue to unwind their positioning. They're not much different than where they were back in April when we were at those extreme lows and we came out of that April low into the, actually that's last year. What am I looking at here? April. Last year, January. So from 2024 all the way into 2025 and then to where we are, they haven't really changed much, right? Look at that level there. It's at about 0.3 and we're at 0.255. So after all that, they're not far off. But bring it over to January 2025. It's where we started the year. It's not perfect, but it's really close. So from January to now, a whole year has gone by and their allocation levels are just about the same. The only difference is they were getting out risk last year or into January of this year. And then they built it back up and now we're here. So are we fading down and getting risk out again? Or are they going to turn it around and come back up? They didn't turn it around last time and come back up, but that's the concern, right? So we want to keep our eye on the CTA positioning, see if it's going to expand higher from here or if it's going to come back down. I'm pretty comfortable with the idea that if it comes back down, they're going to exit out of more stuff and reduce their position size even more. That's the concern. Kind of like back here where we had that sort of a double bottom type behavior. They failed to really allocate more and then broke that level and got even lower. That's the concern. So maybe we run up a little bit above +3 and then dump. I don't know. But keep your eye on CTA positioning. We want to see how heavily allocated they are into the market. Now that's the S&P. There's oil, gold, silver, right? 2-year, 10-year. It's all kinds of charts over there. It's worth taking a look. And they post it sometimes on Twitter. So, even if you don't have an account at Mentor Q, just follow them on Twitter. They'll post some free stuff almost every day. They're trying to give something away to get eyeballs. This is silver and the allocation. You can see they're not allocated back to their previous level yet. So silver's on a tear. It's completely parabolic. It's gone completely out of control. It's ripping up into nosebleed areas, but they're still not as heavily allocated as they were a few months ago. So there's room for more. I don't know how much more. And I mean, if you're long silver, I hope you're taking some profits off the table because, they will, price that does that will mean revert with velocity sooner or later. the Tom Sosnoff had a trade strategy for that called the aggressive contrarian trade strategy. That's a mouthful. The idea is that you go against it. It doesn't always work. I remember he went against Tesla and Apple when they announced a stock split and went parabolic back in like 2020, 2021, something like that. He got run right the hell over. Copper's waking up. Copper has been my China play for the last, I don't know, 16, 18 months, something like that. So this certainly got my attention. Don't know what they're going to do with it. And as you can see from previous rips, they can just dump it right back down again. But we got copper on the move, coming back up to a previous high soon. And the allocation in the CTA positioning is not back at the highs, and it is through this previous resistance. We'll see. I like copper, though. Copper's a good play if you're day trading in the futures and the S&P and the NASDAQ are being sort of grumpy and sideways, and you don't like the way the charts look. Take a look at copper. It's a fairly decent day trade. And we are in the last blackout window of the year. Goldman Sachs estimates currently 40% of the S&P are in their blackout window, with 65% in the blackout by the end of the week. So, when we talk about thin trading volumes and the lack of participation, even the companies that are doing buybacks are in a blackout period. The zero gamma is underneath the put wall, and you can see all of them without even adjusting your screen. Call wall, volatility, trigger, zero gamma, put wall, they're all there. So are the major moving averages, 3, 10, 20, and the 10-week. Step out here to the daily for a moment. We're still in this situation that we don't have an answer to yet. Are we going to print a lower high, a matching high, or a new high that is higher than this high? Not all-time highs, right? We're not that far, but a higher high. And we need this answer for technical analysis to define the next stage, right? So we can't count this yet because of today's bar. If today's bar was to break yesterday's low, close this gap, and say break this midpoint, then we could call that a lower high. But as long as we're just hanging out within yesterday's range, then we can't count any of this as a lower high yet. And that will leave us in this sort of, we don't know, hang out, let's wait and see. I did mention yesterday, by the way, measuring this bar and marking that mid, and you can see how that worked out. Whatever, right? Even broken clocks are right twice a day. I'll get it right once in a while. We got to get past that point and continue to stretch. In low volumes, price can make big moves. That's the way it goes. I know newer traders kind of struggle with this idea, but that's how it works. Right? So it doesn't mean that we have to make big moves, just that it is possible to make big moves easier in a thinner market environment. We do have that bull signal that I talked about last week, the bull surge, the 3 and the 10 crossing after price crossed the 3 and the 10. So this is a really good bull surge signal. price has to outrun the 10 with enough velocity to bring the 3 back through the 10. Now we need to continue that run to the upside to spread all of these moving averages out into a fork pattern. If this doesn't hold and we don't stay up here and move higher, then we're looking at a retrace. The midpoint of this whole measurement see if I can make that line a little bit bigger. Aha. That whole measurement, there's the midpoint. But we also have the low of that green bar that we marked. Those two combined at 66.80. Now I got to put it back where it was. Yeah. So 68.80, that thin little zone right there, is a structure that really needs to keep. It would be okay to pull back from here. That wouldn't be bearish. You know, we wouldn't get too upset about it because we don't want price to be parabolic, right? So it's been a solid run up from, call it, 67.70, 69.30. That's a nice run. We need a good, healthy pullback, maybe find some structure on the 20-day down here, get a bounce, and then make our next leg up. I think that would be healthy. It would close the gap, and it wouldn't just be this solid run from the low all the way up here, which I think would be too much, and we'd take a bigger rejection. But if that's the way it goes, then we'll deal with that. So looking for maybe a pullback of that size and then a run up. Otherwise, let's finish the run, and then we get a pullback, and we could end up with what Adam Grimes calls a pre-consolidation breakout, where we get price sitting in here, winding up for the next leg higher. We are above the 3-week average as well, which does keep us in that bullish bias. $37,000. You can see the volumes are even less today than they were yesterday. That's going to be the expectation for the week, is that it's just going to get less and less and less. This is my last day for this week. I won't be back again until Monday of next week, and then we're just going to do Monday and Tuesday again. We were holding relatively well above the VWAP this morning. Now that we're underneath it, look for reciprocation. Whatever we had distance-wise, how far we got from VWAP on one side, take that measurement and plot it on the other side. And that's what our expectation is. If you do it right now, it gets you pretty much to the Globex low. We could sit there and run what I call a zipper play, which is where we just cross back and forth above and below the VWAP. Railroad, zipper, call it whatever you want. Oftentimes it forms a bit of a megaphone pattern. We'll run a little bit higher and a little bit lower each time until finally it breaks out and starts to go. We don't have the megaphone yet. We don't even have zipper yet because we didn't get the matching distance on the other side. But that's what I would be looking for. What's going to mess it all up is the fact that we've got econ coming, and then patterns go out the window when you've got data like that. So this is the measurement. You could do it with, quadrants and fibs and all that, but you could just draw a line. And as I suspected, that gets us down to the Globex low. See how that works? You know you're doing your analysis correctly when you end up at levels that support your analysis. If we break the Globex low, then we're done with reciprocation and we'll begin to expand, but we'll deal with that when the time comes. For right now, VWAP is the safety zone and price is just hanging out here in that range, waiting on it, waiting and waiting and waiting. All right, we got a market maker move this morning. It's very small. It's a very small market maker move, but it does show that they're adding additional hedges today. Just a little bit. We're sitting inside the ADR, which is, what we'd expect because we're basically flat and we haven't done anything. We didn't get much of a move through the kill zone, a little run up, just that little bit there, and we already unwound it basically. So we have the capacity to go to either one of these two red lines today. Technically, we could go to both today, but unless we get some fuel on this fire, we're not going to go anywhere, right? The expectation would be that we have another sideways day, and we are inside day. The expectation being that we have to get out of this before we do anything else. That's the RTH of yesterday, and then this would be all of yesterday. So for the upside, they're the same thing. We're just looking at an inside day breakout. To the upside, we could get up into that 69.65. To the downside, you have the RTH low, then you break that and you have the real low. You break that and get into the ADR half to the downside, and then you close the gap. And really, if we get that close to the COG line, the 92 COG, and we get that close to closing that gap, oh yeah, we're going to close that gap. I have no doubt in my mind we would close that gap if we get that close to it. It would just act like a gravity and take us right on down there. So that'll be the expectation. If we even get inside this channel, I don't see why we wouldn't come down there, right? So if we get in that area down there at all, should be game on. But to do that, GTFO, we gotta get out of the box. And right now the box is our Globex low. Globex low, RTH low, yesterday's low, into the channel, close the gap. If we get through the gap close and it looks like it wants more, we'll take the full ADR all the way down here at 61. Keep your eye on the market maker move. If you don't have that signal, as long as your platform has options on the futures, you can just come into the options chain. Market maker move is something that was made up by the team that developed Thinkorswim. So no other platform has it because Thinkorswim's creators made it up. They just made it up. What we're looking at is the 0-day options and the next expiring options out. And what we want to see is the implied volatility average greater in the front than it is in the next expiration? If it is, like this is, 7.9 is greater than 7.6, then you'll end up with a market maker move. That's it. If you was to Google market maker move, you'll find articles written by Schwab. TD Ameritrade had over 27 articles, lots of information on it. But now that Schwab owns Thinkorswim, they consolidated all of those articles into like 2. They don't mention futures at all. Me, as an options trader and a futures trader, I just kind of put 2 and 2 together and figured it out on my own. But this is, generally speaking, what they use for binary events, earnings, new drug trials, Investors Day conferences, that sort of stuff. But we can use it in the futures too, because if they're trading and developing hedges, then we can spot it. And well, we've spotted it. So keep your eye on it. We want to see if it's continuing to grow and get bigger, or if the event passed and it can start to shrink. We know today is the GDP numbers, so we know why there's a market maker move. if you're running through your own morning briefing and you come across that market maker move, and it's not a day where we have economic data, you got to call timeout right there and try to figure out why are they hedging? Why are they bringing in additional hedges on a day when there's nothing to be worried about? Because it's a warning to you that they are worried about something, and well, you should try to figure out what it is. No guarantees that you'll actually find it, but oftentimes that was my head up warning that there was something out there that I didn't know about. And then I would go hunting for it, trying to find what the heck it is. Pot stock conferences, big AI conferences back in the day, those were sneaky ones that would trigger a market maker move tag. And yet I didn't know they were coming. Right. So those are some good examples. This has a life only for today, so it will disappear by the end of the day, no matter what, because they're trading options that won't exist tomorrow. So we know it would be done by the end of the day. Always, market maker move will always end by the end of the day. That's a big gap on the floor pivots. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. And we've already tagged it and stayed above it. That's also bullish. We have a MDP. If you look back at yesterday's floor pivot, we never hit it. That's what we call a missed daily pivot, MDP. We would be looking for consecutive missed daily pivots, but we've already hit it. So we don't have a consecutive missed pivots. We barely tickled it though, really, and we didn't break and get underneath it. The wide channel from yesterday suggested that if we broke out, it wouldn't stick. And well, we opened gapped out and it stuck all day long. It's another example that these channels don't make price do anything. So the breakout stuck. The wide channel was not a fortune teller. And today's channel, while it is narrower than yesterday's, it's still a pretty wide channel, all things considered, suggesting that if we break out, it doesn't stick. Well, that didn't work yesterday. Maybe it'll work today. Just remember that the width of these channels doesn't move price. Neither does that floor pivot. The distance from the weekly pivot is a concern, but we're not there yet. It's something to keep our eye on as a metric, but we're only 1% away from the weekly pivot. That's not enough to cause mean reversion at this point. So I wouldn't get too hung up on the idea that, we might be moving a little too far, a little too fast. It doesn't owe us mean reversion at this point. Yesterday, we made it above R1 and was able to keep it finally, but we digested that area for a while, just chewing it up. And we never made it to R2. Now, today, we're still within R1, S1, and R1 is farther away than S1, which means the indicator sees it's more likely that we go up than down. Just remember, this pivot point indicator does not make price do anything. But you can see that the distance to R1, which is that box that I just made, is farther away than the distance to S1. If we just drag that box down here, here's S1 and we've overshot it by a lot. So more likely that we go up than down. If we do begin to fade, let's get through the floor pivot and the lower channel and then get into that S1 and see if it's going to provide support. S1 is RTH low of yesterday. They're overlapping. That makes it multiple levels of support. I like it when we have multiple levels of support and resistance. Adds more structure, right? Whenever we can use the word and, it's a good thing. That's S1 and that's yesterday's RTH low. If we could say, and it's a cog line, and it's a put wall, you see, you just keep adding more ands in there. You can really stack them up. Adds more confidence, confluence. If S1 doesn't hold, game on to S2. That'll close the gap and get us back inside of Friday's range. On the other hand, if we get through R1, R2's on the table. Kind of losing our classic distribution at this point, right? The classic distribution would be more of that D shape with the point of control. This is sort of a lopsided D, not quite a P yet. It's not yet. We'd need a little more tail down here or get up a little bit more, right? Sort of fill this section out. That would get us into that P shape profile. So maybe I'm just being picky, but we do have the point of control up here at 6932 cog line. You can see this is where we're digesting everything. They're putting in the work right here. Are they making their line in the sand? I'm not sure yet. They're certainly defending it like crazy, right? If this is going to be their Alamo, then we'll see them fall on their sword. But it needs to play out. This is that level that we talked about yesterday, right? It's the same spot, the 6932. So if we can get above it, then we've got this other level, this one right up here. It was that 2-hour price action from, well, actually 1 hour, right? From the 4 o'clock to the 5 o'clock time frame. That's where that candle was built. And we want to see what's up there, what's in there. Watch the tape, right? See if it's got a lot of pulling and stacking. We'll see what we get when we get up there, but we got to get there. Ten-day, 30-minute volume profile and TPO. The TPO has already moved up. It's very likely that that's where our point of control is going to go. There's nothing here. We haven't built out a new home, but that 6932 is making one heck of an argument. The concern is we're still wiping out candles on the left, right? That's how it works. We get a new candle on the right, we take one away from the left, and whatever associated volume that was attached to it gets removed as well. Yesterday, it looked like we might see the point of control move a little lower first and then move up. Now it's just looking like it's going to move up. But when we wipe these candles out back here, we have to be concerned that we've built out enough new volume here to keep this high volume structure. The other area is 6960. It's a good chunk, basically all of that right there. 6950 to 6960 as a zone. It's going to be a difficult level to get through. And there's that gap to deal with. Oh, I took a wrong turn there. All right, this is the 5x5. We got the VPOC from Friday into Monday. We don't have a new one from Monday because we sat there crossing back and forth through it last night. So we wouldn't carry forward that as a VPOC, but the textbooks would tell you to do it anyways, at least the value area, because that hasn't been hit yet. Now, me, I've got enough pivots. I don't need another one. But, you know, if you're looking at your trading day and you're thinking, gosh, I need more pivots, then use the value area high and the value area low and the point of control from the previous day's profile. It can't hurt, right? It will provide some structure for you, and it can help you add levels with consistency instead of just randomly picking pivot points. Nothing really stands out for today's profiles. We've got an abandoned distribution buildup around that 25 area, and then all the work has been in here at the 32. it stacks well with yesterday's point of control. And if we did break to the downside, we can see how they started to fill out here, but it looks like it just filled out from default, right? Like that's where we were for a while, and so that's where we put some work in. Not like they came in and really tried to get anything accomplished. So yeah, it builds out here, but it doesn't look intentional. $69.81.5 is the weekly expected move top, and we're nowhere near it. So we're still inside day. If we break out of yesterday's high and make a run to the upside, 69.81.5 is worth considering as a target. We're still above the 10-day at a 0.5%. That's a sweet spot. There's nothing wrong with where we're at. We're not overbought. We're not overextended. We haven't moved it too far too fast. And it does not owe us a pullback or mean reversion based on how far we've moved so far to this point. On the week, we are more than 1.5%. Nothing wrong with this. And we're still, so far, getting these lower highs. Looking for that to break at some point for a new year, right? A new year and a new run. I'd like a reset of all of this. But to get that, we're talking about outrunning the 10-week by 3.5 to 4%. We're going to need jet fuel to get that done. I don't see it happening today. It would take an entire week of just strong push to the upside. What's going to cause that? You know, there's nothing we have coming this week is going to get that done. But that would be a nice reset on the year, right? Because we've been consistently setting these lower highs all the way down. And we did get a nice reset, you know, mid-November. Hopefully that holds and we don't need something a little deeper. At the moment, we're good. I'd like to see this back above 2% at least. It's kind of the sweet spot at its finest. But, you know, anything above 1% on the 10-week is we're good. You get too close to the 10-week and it'll start to act like gravity. It'll just draw you back in, and then you stay in this sort of safety net zone where price doesn't want to leave it. So we're outside of that. We want to stay outside of it so that we don't get drawn back to the 10-week. All right, looking at what's down today. China's down, Bitcoin, more China, more China. Chips are down, not by much, but they are down. There, our benchmark is a 0.5%. We're only down 0.2. That's nothing yet. But you know, China, Bitcoin, gold miners. No, 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 not miners. Shouldn't have said miners. Just Bitcoin and China, really. The others that are down a little bit, they're not down enough to meet that criteria. And looking at what's up this morning, there's our miners. Miners and junior miners. The Mag 7 down volume is up. We got uranium, and then the rest of these, they're not enough. Energy, building materials, bonds. It's odd to see that EEM is up a little bit. That's China too, basically. And it's up slightly. It's kind of disagreeing with all the China stuff down here that's down. But whatever. Being down a little bit is okay. Right? We kind of talked about that at the beginning of this. We need a little bit of a pullback. It's healthy. So we do have a lot of things that are green today, but these aren't the kind of green things that can give us that breakout we need. So these can't fuel it, right? If we're going to get a breakout and a run to the upside today, it's either going to have to be from the headlines on GDP or it's going to come from somewhere else. That could be things like 0-day flows, Mag 7 finally turning around and moving in the right direction, dollar yen behavior, something like that, right? That we would have to start looking around and say, what's causing this push today? And it's not always dealer hedging and dealer positioning, right? Sometimes markets move because of something other than options. Shock, I know. It's almost blasphemy nowadays to mention that maybe the dealers and options didn't have anything to do with it. You don't want a rally day based on solar stocks and pot stocks and parabolic precious metals. It's unsustainable. It won't be a good rally day. And there was a lot of weird conflicting signals yesterday. Right? I posted them in the chat. This is the weighted AD, and I'm more confident on a bullish move in the broader market when it gets above 2.5. It couldn't even get to the 2 yesterday, let alone get above it, but it was positive and it was holding above 100. So in that scenario, we can grind higher. It was one of those days where we could get that grind higher. And this is the ticks. Generally speaking, if we're good bullish, then we should be able to tag 750, no problem, right? We don't want to like tag 1,000 because that's often a signal of a pause or reversal. But getting into that good 7 to 750 area, we should easily do that on a bullish day. And we couldn't, right? And if I snap the Linreg on this, probably won't let me. Yeah. Then the grind was to the downside. We kept losing tick all day, right? Then we had this green line crossover yesterday. I pay particular attention to that green line. Anybody who's read my material knows this. We had a good fork pattern. Everything was spreading out nicely all the way up into 1030. And then that was it. We topped out in the green line, rolled over, started heading to the downside. Now that was some really good signals, but that was heavy bearish signals. Getting green line breakovers like that is negative. Mag 7 was tangled up with that VWAP and could not get anything done. And the banks were tangled up in the VWAP and couldn't get anything done. And then they broke down right there. And if you look at the lower right side of my chart, that's when the C ticks went below 0. Right? See, I'll move it just so you can spot it again. The C ticks went below 0 at that point, and that's when the banks broke that range and really started to move to the downside. So we had a lot of disagreeing signals yesterday, which on the one hand, I know that doesn't necessarily set up for really nice trades, but it's hard to classify how much you didn't lose, right? Like I knew longs weren't safe bets once things started to get ugly in this part here. We knew that longs weren't a safe bet. We weren't getting those signals, and that shorts weren't getting a good signal either. All right. So if I've got conflicting data that is warning me that there's no good solid signal, even if price gives me a nice setup, I'm very likely to ignore it because these are all in disagreement. There's something wrong, and I'd rather preserve capital than get itchy and try to force a trade just because. You'll kind of pick up on that later if you're new to all of this, but forcing a trade just solves your FOMO itch, but oftentimes it doesn't work well for the balance, for the books. Today, as with every day, we got to get out of the box. So short and sweet, get out of this box. If it's to the upside, you've already got the levels 69.50 and then 69.82, which should get that one spot resolved that we've been worried about, and then 7,000. To the downside, break Globex low, RTH low, yesterday's low, get the gap closed. Well, that's 68.92. If we breach that, then 68.50 is on the table, and we can run it for 6,800, because why not? But it'd be level by level all the way down, right? Friday's mid, Friday's RTH low, and then the real low of Friday, then we'd worry about Thursday, right? On and on, we just work it on down. We got SNR levels to worry about. The floor pivot is down there. The weekly pivot is down there. Got a lot of structure in each direction, right? And we've gone through all of that. So if you wasn't writing it down, you can just catch the replay on my YouTube. And while you're there, like, subscribe, do all that good stuff. Heck, even comment on one of the videos. Doesn't hurt anything, right? Helps me out. I really appreciate it. Other than that, guys, this will be the last one until after Christmas. So I hope everybody has a great Christmas. Spend time with the family. And I will see you all next week on Monday.